Before we begin, a quick and important disclaimer. This video is intended for educational and entertainment purposes only and does not constitute professional financial, legal, or insurance advice. The concepts discussed regarding divorce insurance and marital risk management are theoretical or historical in nature and should not be used as a basis for making personal or legal decisions. Insurance regulations vary significantly by jurisdiction, and the U.S. insurance market is subject to strict state-level oversight. Always consult with a qualified attorney or a licensed financial advisor to discuss your specific situation and conduct your own thorough due diligence before entering into any financial contract or legal agreement. Imagine walking down the aisle, the air filled with the scent of lilies and the sound of a string quartet, while in your pocket rests a multi-million-dollar insurance policy against the very person you are about to say "I do" to. It sounds like the plot of a cynical corporate thriller, yet in the landscape of American finance, it represents one of the most complex, controversial, and elusive white whales of the actuarial world. In the United States, we insure our homes against fires that may never happen, our cars against collisions we hope to avoid, and our lives against the one thing that is certain to end. But when it comes to the single most financially devastating event a person can experience, a legal divorce, the traditional insurance market offers almost nothing but a void. We are looking at a scenario where approximately 40% to 50% of first marriages in the U.S. potentially end in dissolution, with even higher rates for subsequent marriages, yet the risk remains largely uninsurable in the conventional sense. This is the divorce insurance gap, a multi-billion-dollar theoretical market that has seen failed startups, regulatory roadblocks, and a fundamental clash between social norms and hard-nosed economic reality. This deep dive is about more than just legal fees. It is about the mechanics of marital risk, the reasons why your insurance agent won't take your broken heart premium, and what historical trends tell us about the future of protecting your net worth from the divorce penalty. For the average American, a divorce is not just an emotional trauma. It is a liquidity crisis. When a household splits, the cost of living does not just double. It often triples due to the loss of shared efficiencies, the duplication of housing costs, and the staggering friction of legal intervention. Historical data suggests that the average contested divorce in the U.S. can range from $15,000 to over $100,000 in legal fees alone. But that is the tip of the iceberg. The true cost lies in the division of assets, the liquidation of retirement accounts, and the potential for long-term alimony or child support payments that can deplete an individual's lifetime earnings by 30% or more. This is the problem we are solving today. Understanding why this risk exists, how it is quantified by the divorce industrial complex, and exploring the theoretical frameworks that could, in another reality, protect a family's financial legacy from being dismantled by a signature in a courtroom. To understand the theoretical market, we must first look at why divorce is considered an uninsurable risk by the giants of the industry like State Farm or Geico. In insurance theory, for a risk to be insurable, it generally needs to meet several criteria. It must be accidental, it must have a definite loss, and it must not be subject to moral hazard. This is where the divorce insurance concept hits its first major wall. Moral hazard refers to the idea that if you are insured against a loss, you might be less likely to prevent that loss from occurring. Critics of the theoretical U.S. divorce insurance market argue that if a spouse knows they have a $250,000 payout waiting for them upon the filing of a decree absolute, they may be less inclined to engage in the difficult emotional labor required to sustain a marriage during its inevitable low points. However, proponents argue that this is a simplistic view. They compare it to fire insurance. Just because your house is insured doesn't mean you want to see your memories turn to ash. Let's look at a historical case study to see how this was actually attempted on American soil. In the late 2000s, a company called Safeguard International launched a product known as marriage assurance. It was marketed not as a divorce policy, but as a supplemental marital asset protection tool. The way it worked was fascinating from an actuarial standpoint. Instead of a traditional death benefit, it utilized a unit system. A policyholder would buy units of coverage. For example, one unit might cost $15 a month and provide a $1,250 benefit. The catch, and this is a critical structural detail, was the elimination period. You could not claim the benefit until you had been a policyholder for at least 48 months. This was designed to combat adverse selection, the insurance term for the phenomenon where only people who know they are about to get divorced would sign up for the policy. By forcing a 4-year waiting period, The company ensured that only those committed to the long-term stability of their marriage, or those who were very patient, would enter the pool. Despite the rigorous math, Safeguard faced an uphill battle with state regulators. In the U.S., insurance is regulated at the state level, not the federal level. This means a company must get approval from 50 different insurance commissioners, each with their own interpretation of public policy. Many regulators view divorce insurance as a wager on the failure of a marriage, which is legally frowned upon. This highlights the social stigma barrier. In the U.S., we view marriage as a sacred bond, and the introduction of a financial hedge against that bond is often seen as a self-fulfilling prophecy. Yet, when we look at the potential outcomes of a divorce, poverty for stay-at-home parents, the disruption of children's education funds, and the forced sale of family homes, the educational argument for a safety net becomes much more compelling. Consider the divorce gap in terms of retirement. When a 401k or a pension is split via a qualified domestic relations order, QDRO, the immediate tax implications and the loss of compounding interest can be catastrophic. In a theoretical insurance model, the policy would act as a buffer. Instead of splitting the actual retirement account, the insurance payout would provide the non-employee spouse with a cash settlement, allowing the retirement fund to remain intact and continue growing. This would be a win-win outcome in a high-friction environment. Historical trends in the U.S. show that the wealth gap between married and divorced individuals continues to widen, particularly for women over the age of 50, a demographic often referred to as gray divorcees. For this group, the lack of an insurance mechanism isn't just a financial quirk, it's a systemic vulnerability. As we move through this masterclass, we will explore the actuarial tables of heartbreak. If an insurance company were to underwrite your marriage today, what factors would they look at? They would look at the age you got married. Statistically, those who marry before age 25 have a significantly higher loss ratio. They would look at your education level, your combined income, and even whether your parents stayed together. These are the cold, hard metrics that define the risk profile of a U.S. household. By understanding these metrics, you aren't just learning about a theoretical insurance product. You are learning how the financial world quantifies the stability of the American family. We are going to break down the cost of conflict and look at how no-fault divorce laws change the risk landscape from a contingent liability to a voluntary exit, and why that single legal shift made insuring marriages almost impossible for traditional carriers. We are solving the mystery of why, in a country that can buy insurance for a professional athlete's throwing arm or a singer's vocal cords, we still haven't figured out how to insure the most important financial contract of our lives. This is the deep dive into the U.S. divorce insurance market. To grasp why the U.S. divorce insurance market remains a theoretical titan rather than a practical reality in 2026, we have to look at the cold, hard mathematics of actuarial underwriting. In a standard insurance model such as life or fire, the insurer relies on the law of large numbers. This principle suggests that while it is impossible to predict when one specific house will burn down, it is very easy to predict how many houses out of 100,000 will burn down in a given year based on historical trends. However, divorce introduces a variable that terrifies underwriters: the human element of intentionality. In 2026, if an insurance company were to attempt to price a policy for a couple, they wouldn't just look at your bank statements. They would look at your risk profile through the lens of the hazard function. The hazard function in marital statistics reveals a very specific trend. The risk of divorce is not linear. It does not start at zero and slowly climb. Instead, historical trends show a massive spike in the first 7 to 10 years of marriage, followed by a gradual decline, and then a secondary, smaller spike during the empty nest phase. This nonlinear risk makes pricing a premium incredibly difficult. If a company charges a flat rate, they lose money during the high-risk early years. If they charge more in the beginning, young couples, who are usually the most financially strapped, simply won't buy it. Imagine a couple in 2026 named Michael and Sarah. Michael is a software engineer and Sarah is a freelance designer. They are 28 years old and just got married. In a theoretical market, an underwriter would see them as a high-velocity risk. The company might demand a monthly premium of $400 for a $100,000 benefit. For Michael and Sarah, who are already struggling with 2026 inflation and a high-interest mortgage, that $400 represents a significant portion of their discretionary income. This leads us to the first major hurdle of the deep dive: the adverse selection death spiral. Adverse selection occurs when the people most likely to experience a loss are the only ones who buy the insurance. Imagine if the only people who bought flood insurance were people whose basements were currently filling with water. The insurance company would go bankrupt overnight. In the divorce market, this is a constant threat. If the market were open and unregulated, a spouse who suspects their partner is unhappy might secretly take out a policy. To counter this, theoretical models in 2026 suggest a mandatory 2-signature requirement and a 5-year vesting period. You pay into the system for 60 months before you are even eligible to file a claim. If you divorce in year 3, you lose every penny of the premiums paid. This creates a psychological barrier. It turns the insurance into a commitment device, where the financial penalty of an early divorce is compounded by the loss of the insurance investment. Let's look at a case study involving the 2026 housing market to see how this insurance would solve a modern problem. Michael and Sarah bought a home in 2024 with a 7% interest rate. By 2026, home prices have plateaued, but the cost of selling, including agent commissions, closing costs, and moving fees, hovers around 10% of the home's value. In a typical U.S. divorce, the house is the largest asset and often must be sold to split the equity. This is frequently a net loss event. The couple loses their home, their low interest rate, and a chunk of their equity to transaction costs. If they had a theoretical divorce insurance policy, the potential outcome changes. Instead of a forced sale, the insurance payout could provide the liquidity needed for Michael to buy out Sarah's half of the equity, or vice versa. The policy acts as a shock absorber, preventing the destruction of the most stable asset in the American middle-class portfolio. Beyond the home, we must consider the legal friction. In 2026, the average cost of a contested divorce in a major U.S. city like Los Angeles or New York can easily exceed $50,000 per person when you factor in forensic accountants, child custody evaluators, and discovery costs. This is where the concept of legal fee indemnity comes into play. Most people assume divorce insurance would be a cash windfall, but a more sustainable theoretical model is the service-based indemnity model. In this scenario, the insurance doesn't give you a check. It provides you with a pre-vetted legal team and a cap cost resolution process. This shifts the incentive. Instead of attorneys having an incentive to drag out a case to bill more hours, the insurance company, as the primary payer, has an incentive to push for a mediated settlement as quickly as possible. Imagine if your policy functioned like a high-end HMO for your marriage. If you hit a rough patch, the policy would first trigger a mandatory period of marital counseling, fully covered by the premium. If counseling fails, the policy then transitions into the legal phase. This creates a step-by-step framework that prioritizes the preservation of the marriage before the liquidation of the assets. Historical trends in the U.S. show that many divorces are the result of temporary financial stress rather than fundamental incompatibility. By providing a financial buffer and professional intervention, the insurance could, ironically, lower the very divorce rate it was designed to protect against. However, we have to talk about the liquidity trap. For an insurance company to pay out a $100,000 benefit to 40% of its policyholders, it needs to be sitting on a mountain of cash that is generating returns higher than the rate of divorce. This is where the math starts to break down in a low interest rate or volatile market. If the divorce rate in the U.S. stays at its current historical levels, the premiums would have to be so high that they would be indistinguishable from a standard savings account. This is why many financial experts in 2026 argue that divorce insurance shouldn't be a standalone product, but rather an add-on or a rider to a whole life insurance policy. By bundling the risk of divorce with the certainty of death, the insurance company can smooth out its cash flow. But there is a darker side to the theoretical market that we have to examine: the incentive for sabotage. If a policy is too generous, it creates a potential outcome where one spouse is financially incentivized to end the marriage. In the U.S. legal system, we have moved almost entirely to a no-fault system. This means you don't need a reason to get divorced, you just need to want out. If you combine no-fault laws with a high payout insurance policy, you create a system ripe for exploitation. This is why theoretical 2026 models focus on the indemnity principle, which states that insurance should return you to the position you were in before the loss, not leave you better off. The policy wouldn't make you rich. It would simply prevent you from becoming poor. We also have to consider the role of the third-party payer. In many corporate environments in 2026, we are seeing the rise of marital stability benefits. Some high-end tech firms have begun offering family protection plans as part of their compensation packages. These are essentially group divorce insurance policies. The company pays the premium because they know that a distracted, stressed employee going through a messy divorce is 30% less productive and more likely to quit. By providing a structured, insured path through a divorce, the employer protects their human capital. This shifts the divorce insurance market from a consumer-led product to an institutional-led product, which fundamentally changes the regulatory landscape. As we look at these models, a question begins to emerge. If we can calculate the risk, if we can build the legal frameworks, and if we can find the institutional backing to fund these policies, why hasn't a major player like Berkshire Hathaway or Vanguard stepped into the ring? The answer lies in a hidden variable that most people never consider: the influence of the state and the tax code. The US government actually has a vested interest in the current system, and the way divorce is taxed in 2026 creates a massive barrier to insurance innovation. We've talked about the math of the risk and the logic of the premiums, but we haven't touched on the most explosive part of this theoretical market. What happens when the insurance company decides that your marriage is too risky to keep insuring? Can an insurance company drop you because you have too many arguments? And more importantly, how would a theoretical insurance payout affect your alimony and child support obligations in a US court? In the next part, we are going to dive into the blacklist and the courtroom clash, where we explore how the introduction of insurance could actually make your divorce more expensive, not less. We will look at the 2026 tax implications that could turn a $100,000 payout into a $40,000 nightmare. You won't want to miss how the IRS views your protected assets. To understand the tax quagmire of a theoretical US divorce insurance market in 2026, we first have to look at how the Internal Revenue Service traditionally views insurance proceeds. Under Section 101A of the Internal Revenue Code, life insurance payouts are generally excluded from gross income because they are intended to provide for survivors after a death. However, divorce insurance does not fit this mold. In the eyes of a 2026 tax auditor, a divorce insurance payout would likely be categorized as either a return of basis or a taxable windfall. If the payout exceeds the total amount of premiums you paid into the policy over the years, the IRS may treat that excess as ordinary income. Imagine a scenario where a policyholder, let's call him David, paid $20,000 in premiums over a decade and receives a $100,000 settlement upon his divorce being finalized. According to potential outcomes based on current tax logic, David might owe federal income tax on $80,000 of that payout. At a 2026 marginal tax rate, he could be looking at losing nearly $24,000 immediately to the government, effectively shrinking his safety net before he even pays his first month of separate rent. This leads us to the concept of Section 1041 transfers. In the United States, transfers of property between spouses incident to a divorce are typically non-taxable. However, an insurance payout from a third-party corporation is not a transfer between spouses. It is a contract fulfillment from an external entity. This creates a massive structural disadvantage. If a husband gives a wife $100,000 as part of a settlement, there is no immediate tax hit. If an insurance company gives her that same $100,000, the IRS wants their cut. This tax friction is one of the primary reasons why high-net-worth individuals in 2026 often prefer traditional prenuptial agreements over theoretical insurance products. The math simply doesn't favor the insurance model unless the payout is specifically structured as a non-taxable indemnity for legal expenses, which would function more like a health insurance reimbursement. But the tax bill is only the first half of the nightmare. The second half is what we call the courtroom clash. In a U.S. family court, judges have broad discretion to determine what is fair and equitable. When a judge looks at the financial affidavits of two divorcing parties, they are looking for a balance of need and ability to pay. Consider the case study of a 2026 divorce between Jennifer and Mark. Jennifer has a theoretical divorce insurance policy that pays her $150,000. Mark, aware of this payout, argues in court that because Jennifer is receiving this lump sum, his obligation for alimony or spousal maintenance should be reduced or eliminated entirely. Mark's legal team would argue that Jennifer's need for support has been mitigated by her private contract. This creates a paradox. The insurance Jennifer bought to protect herself actually becomes a weapon used against her to reduce her court-ordered support. This is known as the double-dipping defense. Historically, in cases involving disability insurance or personal injury settlements, U.S. courts have struggled with whether these payouts should be considered income for the purposes of calculating support. If a 2026 judge decides that a divorce insurance payout constitutes gross income, it could not only lower the alimony Jennifer receives, but could also increase the amount of child support she is expected to contribute to the household. Instead of the insurance being an extra layer of protection, it simply replaces the support she would have gotten from her ex-spouse, leaving her in the exact same financial position she would have been in without the policy, but minus the thousands of dollars she spent on premiums over the years. Step by step, the integration of an insurance payout into a U.S. divorce decree would look like this. First, the policyholder must disclose the existence of the policy during the mandatory financial discovery phase. Failure to disclose could lead to charges of perjury or a setting aside of the final judgment. Second, the court must determine the characterization of the funds. Is it a marital asset to be split 50-50, or is it separate property belonging only to the spouse who paid the premiums? If Jennifer paid for the policy using a joint bank account during the marriage, Mark could theoretically claim half of the insurance payout that was triggered by him leaving her. This is the ultimate irony of the theoretical market. The person you are insuring against may have a legal claim to the very money meant to protect you from them. Furthermore, we have to look at the impact on child support guidelines. Most U.S. states use a standardized formula to calculate child support based on the combined gross income of both parents. In 2026, the definition of gross income is expansive. It often includes severance pay, Social Security benefits, and yes, even certain insurance settlements. If a $200,000 divorce insurance payout is factored into the gross income calculation for a single year, it could artificially inflate a parent's income, leading to a child support order that is completely unsustainable once the insurance money is spent. This creates a cliff effect where the parent is left with a high legal obligation, but no recurring revenue to satisfy it. To add more depth to this masterclass, let's explore the step-by-step process of how an insurance company would actually verify a claim. In a car accident, the company sends an adjuster to look at the dented fender. In a divorce, the insurance company would essentially become a silent party to your divorce litigation. They would require copies of all motions, depositions, and the final signed decree from a judge. They would likely have a special investigative unit, SIU, to ensure the divorce wasn't staged for the payout. Imagine a 2026 couple who are deeply in debt and decide to get a paper divorce just to trigger a $500,000 insurance payout, only to continue living together in a house they bought with the proceeds. This is insurance fraud, and the tools insurance companies use to track this, from social media monitoring to private investigators, would be turned on the policyholders during the most sensitive time of their lives. This level of scrutiny is why the theoretical market has struggled to gain traction. Most Americans value their privacy during a divorce, and the thought of an insurance claims adjuster interviewing their neighbors or checking their GPS data to see if they are actually living apart is a deterrent. We are seeing a historical trend where consumers prefer the certainty of a legal contract, like a prenup, over the invasive verification process of an insurance claim. But what if you are the one the insurance company doesn't want to cover? Just as health insurance companies once used pre-existing conditions to deny coverage, a theoretical divorce insurer in 2026 would use your relationship history. If you have been divorced twice before, your risk profile is mathematically higher. In the insurance world, this is called a blacklist. You might find yourself uninsurable, or your premiums might be so high that they exceed the potential benefit of the policy. This brings us to a massive ethical and economic question. Does divorce insurance create a two-tiered society where only the wealthy and the low-risk can afford to protect their futures, while those most at risk are left completely exposed? As we move forward, we have to talk about the nuclear option. What happens when the insurance company isn't the one paying out, but the one being sued? And more importantly, how do these theoretical policies interact with the growing trend of gray divorce among the baby boomer and Gen X populations in 2026? There is a specific legal loophole involving ERISA and pension plans that could make or break your entire financial strategy. We are going to peel back the curtain on the institutional gatekeepers and the hidden fees that could drain your payout before it even hits your bank account. In the next part, we will expose the blacklist criteria and the specific red flags that will get your application rejected in seconds. You need to know what the underwriters know before you even think about signing a policy. Do you have a pre-existing marital condition? You're about to find out. The underwriting process for a theoretical U.S. divorce insurance policy in 2026 would look less like a friendly chat with an agent and more like a forensic audit of your entire personal and financial existence. When you submit an application, you are stepping into a predictive modeling engine that uses thousands of data points to assign you a marital risk score. This is the black box of the industry, and understanding the criteria for the blacklist is essential for anyone studying this theoretical market. The first and most significant red flag is what underwriters call the sequential loss pattern. Historical trends in the United States suggest that while the divorce rate for first marriages is significant, the rate for second marriages climbs to approximately 60%, and for third marriages, it skyrockets towards 73%. From an actuarial standpoint, if you are applying for a policy on your third marriage, you are not a customer. You are a high-probability liability. Imagine a 2026 applicant named Chloe. Chloe is 34, successful, and entering her second marriage with James. On paper, they look like the perfect couple. However, the underwriting engine flags Chloe because her previous marriage lasted less than 4 years. In the world of marital risk, short-duration previous marriages are a primary indicator of what is known as low-friction exit behavior. Underwriters look for resilience and the ability to navigate conflict. If the data shows a pattern of quick exits, the insurance company will likely issue a flat rejection or a premium so high it acts as a soft denial. This is the start of the blacklist. It is not just about your past, it is about your statistical trajectory. Beyond personal history, underwriters in 2026 would likely analyze socioeconomic volatility. This isn't just about how much money you make. It is about the stability of that income. Historical data indicates that financial stress is one of the leading catalysts for marital dissolution in the U.S. If James is a gig economy consultant with fluctuating monthly earnings and Chloe has significant student loan debt, the underwriting model predicts a higher likelihood of domestic tension during economic downturns. Step by step, the insurer would examine your debt-to-income ratio, your credit utilization, and even your history of job hopping. In their view, if you cannot commit to a car loan or a career path, the mathematical probability of you committing to a 30-year marital contract is diminished. Then we encounter the most controversial element of the theoretical 2026 market: sentiment analysis and digital footprint monitoring. To avoid adverse selection, companies would use AI-driven tools to scan public social media records, looking for what they call pre-claim discord. If Chloe and James have a history of public disputes, or if their digital interaction patterns show a sudden drop in engagement, the insurer might classify this as a pre-existing marital condition. Just as you cannot buy fire insurance while your curtains are smoldering, you cannot buy divorce insurance if the algorithmic indicators suggest the relationship is already in a state of decay. This creates a gatekeeping system where only the most stable-appearing couples are granted the protection, leaving those in high-stress environments, who arguably need the safety net the most, completely uncovered. Now let's look at the institutional gatekeepers that complicate this further, specifically the Employee Retirement Income Security Act of 1974, known as ERISA. This is a federal law that sets minimum standards for most voluntarily established retirement and health plans in private industry. In the U.S., most people's primary wealth is tied up in employer-sponsored 401k plans or pensions. When a divorce occurs, these assets are usually divided using a Qualified Domestic Relations Order, or QDRO. The theoretical conflict arises when an insurance payout interacts with these federal protections. Imagine if Chloe has a $500,000 pension protected by ERISA. In a typical 2026 divorce, a judge might order that James is entitled to 50% of that. However, if Chloe has a divorce insurance policy that pays James $250,000 upon the split, she might assume her pension is safe. But here is the legal loophole. ERISA often preempts state laws and even private contracts. A federal court might rule that the insurance payout cannot be used as a substitute for the pension split required by law. This leads to a potential outcome where Chloe pays the insurance premium for years, James gets the insurance payout, and then James still gets half of her pension anyway because federal law overrides her private insurance contract. This is the ERISA trap, a scenario where the lack of coordination between federal retirement law and state-regulated insurance products leads to the double depletion of the policyholder's assets. Furthermore, we have to account for the hidden fees that drain the value of these theoretical policies. In 2026, an insurance company wouldn't just take your premium. They would charge an annual underwriting maintenance fee to reevaluate your risk. If you move to a state with a higher divorce rate, like Nevada or Arkansas, your premium could see a geographical surcharge. If you have a child, the complexity of the potential settlement increases, triggering a dependent rider fee. These costs can eat away at the potential benefit to the point where the policyholder is essentially just paying for an expensive restricted savings account. Let's look at a case study of a failed implementation of a similar concept. Historically, Some U.S. legal service plans attempted to offer a version of this by providing low-cost divorce representation. What they found was that the presence of the insurance actually increased the duration of the litigation. When the parties weren't paying $400 an hour out of their own pockets, they were less likely to compromise. They would fight over the smallest household items because the insurance was footing the bill for the attorney's time. This is the moral hazard of litigation. In 2026, a theoretical insurer would have to implement a strict copay or deductible system for legal fees to ensure that the policyholders still have skin in the game. Without this, the insurance doesn't solve the problem of messy divorces. It subsidizes them. We must also consider the role of the state insurance commissioners. In the U.S., every insurance product must be approved for sale in each specific state. Commissioners often reject products that they believe violate public policy. There is a strong legal argument that divorce insurance encourages the breakdown of the family unit, which is contrary to the state's interest in social stability. Therefore, even if a company like Chloe's is willing to pay, the state of New York or Florida might simply ban the product entirely, leaving the market fragmented and inefficient. You could buy a policy in one state, move to another for work, and find that your policy is no longer legally enforceable in your new jurisdiction. As we peel back the layers of this theoretical market, we start to see that the math of insurance and the reality of family law are in a state of constant war. The underwriters are trying to turn love into a spreadsheet, while the courts are trying to turn spreadsheets back into equity. But there is a group of people for whom this math is even more urgent. In 2026, the fastest growing segment of the divorce market isn't young couples like Chloe and James. It is people over the age of 50. This is the gray divorce phenomenon, and the stakes here are not just about a first home or a small savings account. We are talking about the complete destruction of a 40-year retirement plan. In the next part, we are going to explore the nuclear option for gray divorcees and how the theoretical insurance market handles the endgame scenario. What happens when there is no time left to recover financially? We will look at the specific 2026 strategies used by the silver splitters and why the insurance industry views an aging population as a ticking time bomb. You will see how a single medical diagnosis can trigger a cancellation for cause clause that leaves a spouse stranded just when they need protection the most. The intersection of health, aging, and marital risk is where the theoretical market gets truly dark. Keep watching because the rules of the game change entirely when the clock is running out. The phenomenon known as gray divorce is not just a statistical trend in 2026. It is a full-scale financial crisis that the theoretical U.S. divorce insurance market has struggled to price. Historical trends show that since the 1990s, the divorce rate for U.S. adults over the age of 50 has more than doubled, and for those over 65 it has tripled. This demographic shift is particularly lethal to the insurance model because of a concept called time poverty. Unlike the 28-year-old software engineer we discussed earlier, a 62-year-old retiree has almost no runway to rebuild their nest egg. If their assets are halved in a 2026 courtroom, they face a permanent reduction in their quality of life. This is why the theoretical senior marital rider is the most expensive and complex product in the actuarial playbook. Imagine a case study of Robert and Linda, a couple living in Florida in 2026. They have been married for 34 years. Robert is 63, a retired project manager with a healthy pension and a 401k totaling $1.2 million. Linda, 61, spent 15 years out of the workforce raising their children and currently works part-time. In a standard U.S. divorce scenario, Linda would likely be entitled to half of the retirement assets and potentially permanent spousal support. However, in 2026, the cost of living, specifically healthcare and housing, has made it mathematically impossible for two households to exist on the same income that barely supported one. Robert and Linda are facing the silver splitter trap, the realization that the cost of their freedom is mutual poverty. Now, imagine if Robert and Linda had purchased a theoretical longevity marital rider 20 years prior. In this 2026 scenario, the insurance company would be looking at a claim triggered not by a sudden betrayal, but by what is known as lifestyle drift or medical friction. This brings us to the darkest corner of the market, the intersection of health and marital risk. Insurance underwriters have discovered that a major medical diagnosis for one spouse is one of the highest predictors of divorce in the senior demographic. If Robert is diagnosed with an early-onset cognitive decline or a chronic physical disability, the strain on the marriage increases exponentially. In a theoretical insurance contract, there is a mechanism called the underwriting reevaluation clause. If Robert's health changes significantly, The insurance company may view the marriage as a sinking ship. From their perspective, the risk of a divorce payout has transitioned from a possibility to a mathematical certainty. This is where we see the emergence of the cancellation for cause clause. If the insurer can prove that the divorce is being sought primarily to protect assets from being drained by medical bills, a strategy often called a Medicaid divorce, they may deny the claim entirely. Let us break down the step-by-step mechanics of a Medicaid divorce in 2026 and why an insurance company would fight it. In the U.S., to qualify for Medicaid-funded long-term care, an individual must have very limited assets. A common legal strategy is for a couple to divorce so the healthy spouse can keep the majority of the assets, while the ill spouse qualifies for state aid. If Robert and Linda attempted this, a theoretical insurance company would classify this as strategic dissolution. Their investigative units would look for evidence that the couple still functions as a unit, sharing a residence, attending appointments together, or maintaining joint social lives. If the insurance company determines the divorce is a financial maneuver rather than a genuine breakdown of the marital bond, the payout is canceled, and the couple is left with the legal fees of a divorce they didn't even want. Furthermore, the theoretical 2026 market must account for the Social Security maximization gap. In the U.S., a divorced spouse is often entitled to a portion of their ex-partner's Social Security benefits if the marriage lasted at least 10 years. However, if an insurance payout is large enough, it could inadvertently affect the taxability of those Social Security benefits. If Linda receives a $300,000 insurance settlement, the IRS may view that as significant income for that tax year. This could trigger the Social Security tax torpedo, where Linda loses a massive percentage of her monthly government check to federal taxes because her insurance payout pushed her into a higher bracket. This is another example of how the theoretical safety net can accidentally become a financial anchor. Step by step, the 2026 actuarial tables for seniors also factor in the recapture clause. This is a provision where the insurance company has the right to claw back a portion of the payout if the couple reconciles or remarries within a certain time frame. For seniors, this is particularly relevant. Historical trends show that many gray divorcees eventually seek companionship again, often with the same person they divorced after the initial financial panic has subsided. The insurance company, having paid out hundreds of thousands of dollars to protect Linda's retirement, would not want to see that money being used to fund a second honeymoon with Robert. This leads to a level of post-divorce surveillance that many find intrusive, where the company monitors the personal lives of the insured for years after the settlement. To add even more depth, we must examine the specific asset classes of 2026. Many seniors hold their wealth in fixed-income vehicles or annuities. If a divorce insurance policy is designed to protect these, it must be indexed to inflation. A $100,000 payout that looks substantial in 2010 might only cover 6 months of assisted living in 2026. Therefore, the premiums for a truly effective senior policy must be dynamic, increasing as the cost of healthcare rises. This makes the product unaffordable for the very people who need it. It creates what economists call the protection paradox. The only people who can afford the insurance are the ones who have enough money to survive a divorce without it. Consider the imagine-if scenario where Robert and Linda's house has a reverse mortgage, a common 2026 financial tool. If they divorce, the terms of the reverse mortgage might require immediate repayment because the primary residence has changed. The theoretical insurance policy would need a specific reverse mortgage indemnity rider to cover this sudden debt. Without it, the insurance payout wouldn't go to Linda's retirement. It would go straight to the bank to prevent a foreclosure on the family home. The complexity of these overlapping financial contracts is why a deep dive review of this market reveals more pitfalls than solutions. As we move toward the halfway point of this masterclass, we have to look at the global perspective. While we have focused on the US, other countries have experimented with different forms of marital safety nets. Why has the US been so resistant to the socialized models seen in parts of Europe? And more importantly, what is the role of the Silicon Valley disruptors in all of this? In 2026, we are seeing the rise of peer-to-peer marital risk pools. This is the Wild West of the theoretical market, where couples are bypassing traditional insurance companies entirely and insuring each other through decentralized networks. But there is a massive risk lurking in these new models, the risk of the exit fee. Some of these 2026 startups are experimenting with a model where the insurance is free, but the cost of leaving is a permanent percentage of your future earnings. We are going to explore the digital prenup and the rise of the smart contract divorce. In the next part, we will dive into the code behind the commitment. How do you program a marriage into a blockchain? And what happens when the algorithm decides you are no longer compatible? We are moving from the courtroom to the server room, and the implications for your privacy and your wallet are staggering. You need to see how the 2026 tech giants are planning to monetize your relationship status. Keep watching because the next level of marital risk is already being coded. The transition from traditional paper contracts to self-executing code is the single most significant evolution in the theoretical 2026 U.S. divorce insurance market. We are entering the era of the smart contract divorce, a concept where the binary logic of the blockchain replaces the subjective interpretations of a human judge. In this 2026 landscape, a couple named Alex and Taylor represents the new generation of digital natives. Instead of a dusty filing cabinet in a lawyer's office, their marital agreement exists on a decentralized ledger. This is not just a digital version of a prenup. It is a live, reactive financial instrument that integrates directly with their banking apps, brokerage accounts, and property titles. Step by step, the implementation of a 2026 smart contract divorce works through a sequence of automated triggers. First, the couple establishes a joint digital vault where a portion of their income is automatically diverted into a staked insurance pool. This pool is governed by a decentralized autonomous organization, or DAO, specifically designed for marital risk. Unlike a traditional insurance company with a CEO and a board of directors, the DAO is managed by code and a community of other insured couples who vote on protocol upgrades. By staking their assets, Alex and Taylor are essentially entering into a peer-to-peer insurance agreement with thousands of other U.S. households. The central challenge for this theoretical model is the oracle problem. In blockchain terms, an oracle is a third-party service that provides external data to a smart contract. For a divorce insurance payout to trigger in 2026, the code needs a reliable source of truth to confirm that the marriage has actually ended. This is where the integration with U.S. digital court records becomes vital. In states like Delaware and Wyoming, which have led the way in blockchain-friendly legislation, the court's digital signature on a final decree of dissolution acts as the oracle's data point. Once the oracle verifies the decree, the smart contract executes instantly. There are no months of waiting for a check to clear or for assets to be sold. The code liquidates the joint holdings and distributes the insurance payout to the individual digital wallets of Alex and Taylor, according to the pre-programmed percentages. However, the potential outcomes of this automated system introduce a new type of risk: algorithmic rigidity. In a traditional 2026 courtroom, a judge can look at the nuance of a situation. Perhaps one spouse sacrificed their career to support the other through medical school, or there are specific needs for a child that weren't anticipated 10 years ago. A smart contract by design has no empathy. It follows the if-then logic to the letter. If the contract was programmed to split assets 50-50 upon a filing in year 7, that is exactly what it will do, regardless of any intervening life events. This creates a scenario where the efficiency of the tech world clashes violently with the messy reality of human life. Beyond the blockchain, we must examine the role of big tech in the monetization of relationship status. In 2026, the major platforms you use for communication and social networking have access to what sociologists call sentiment data. Every message sent, every calendar invite declined, and every change in geographic movement patterns provides a data point for an AI to predict the likelihood of a breakup. Historically, tech companies have used this data to target ads for moving companies or dating apps. But in the theoretical 2026 insurance market, this data is being sold to underwriters to adjust risk profiles in real time. Imagine Alex and Taylor are using a relationship health app that is integrated with their insurance policy. The app's AI notices a significant increase in keywords associated with conflict in their private messages and a 40% decrease in shared calendar events over a 3-month period. Under the terms of a theoretical dynamic premium policy, the insurance company could automatically raise their monthly premiums because their marital risk score has spiked. This is the birth of the relationship credit score. Just as your driving habits can influence your auto insurance rates through a telematics device in your car, your relational habits could determine the cost of your marital safety net. This brings us to the concept of the exit fee model, a controversial 2026 startup trend. Some tech-driven firms are offering what they call low-barrier protection. These policies have very low monthly premiums, making them accessible to lower-income U.S. households. However, the catch is in the fine print. Instead of paying for the insurance upfront, the couple agrees to a permanent revenue share if they divorce. This means the insurance company becomes a silent partner in your future. If Alex and Taylor divorce under this model, the insurance company pays for the immediate legal fees and provides a cash settlement, but in exchange, they take a 1% or 2% royalty from both Alex and Taylor's gross income for the next 20 years. Historical trends in the U.S. education sector, particularly with income share agreements for college tuition, suggest that these models can be both life-saving and incredibly restrictive. For a divorced individual in 2026 trying to start over, a permanent 2% tax to a private insurance company can feel like a life sentence. Yet, for someone with no other access to liquidity during a crisis, it might be the only viable potential outcome. The educational review of this market shows a clear trajectory. We are moving away from the idea of insurance as a simple payout and toward insurance as a complex, long-term financial entanglement. Furthermore, we must address the security risk of the digital prenup. In 2026, if your marital agreement is stored as a smart contract, it is susceptible to the same vulnerabilities as any other piece of software. If the code has a bug, or if the private keys to the joint vault are lost or stolen, the entire insurance safety net can vanish in an instant. There are already case studies in the broader crypto market, where millions of dollars have been locked in faulty contracts with no way to retrieve them. Imagine a couple who is legally divorced but whose $200,000 payout is stuck in a dead-end loop of code because the Oracle failed to update correctly. In the theoretical 2026 market, you don't just need a lawyer. You need a smart contract auditor. As we dive deeper into the mechanics of these digital systems, a more fundamental question arises. Is the presence of this technology actually changing the nature of the American marriage? When every interaction is a potential data point for an insurance premium, and when the exit path is pre-programmed into a server, does the till death do us part vow lose its weight? We are seeing a historical shift where the financialization of intimacy is reaching its logical conclusion. But there is one player in this game that we haven't fully explored yet: the U.S. government. While the tech giants are building the servers, the regulators in Washington, D.C. are looking at the potential for a national marital stability fund. They are worried about the systemic risk of millions of citizens entering poverty due to the high cost of the U.S. divorce system. In the next part, we are going to look at the federal intervention scenarios. What happens if the government makes divorce insurance mandatory, much like health insurance? We will explore the 2026 tax credits for stable marriages and the divorce penalty that could be coming to your 1040 form. You need to see how the public sector is planning to use your tax dollars to hedge against the social cost of heartbreak. The line between your private life and the public ledger is about to disappear. By 2026, the discussion around the theoretical U.S. divorce insurance market has shifted from the boardrooms of private equity firms to the halls of Congress. To understand why, we have to look at the government as the ultimate reinsurer of American social stability. Historical trends suggest that the single greatest predictor of a household falling below the poverty line is the dissolution of a marriage, particularly in households with children. When a family splits in 2026, the immediate economic shock often forces the participants to rely on the public safety net, Medicaid, the Supplemental Nutrition Assistance Program, and housing vouchers. From a federal policy perspective, divorce isn't just a personal tragedy. It is a massive, unbudgeted liability for the American taxpayer. This realization has led to the theoretical development of what policy wonks call the National Marital Stability Fund. Imagine a 2026 scenario where the federal government decides to treat marital risk with the same level of systemic urgency as it treats health insurance or unemployment. In this reality, we see the emergence of the individual marital mandate. Much like the legislative framework of the early 2010s, this theoretical policy would require all married couples filing joint tax returns to demonstrate they have minimum essential marital coverage. This wouldn't be a government-run insurance plan, but rather a mandate that forces the private market to offer accessible, low-cost, catastrophic divorce policies. The logic is simple. By forcing everyone into the risk pool, the premiums for high-risk individuals are subsidized by the low-risk majority. Let's look at a case study of a character named Kevin, a mid-level manager living in Columbus, Ohio, in 2026. Kevin is preparing his federal tax return on a Tuesday evening. As he navigates the digital filing software, he encounters a new section, Form 88M, the Marital Stability Assessment. Under the theoretical 2026 tax code, Kevin must provide a verification code from his licensed marital insurance provider. If Kevin and his spouse have maintained their policy for the entire fiscal year, they are eligible for the stable marriage tax credit. a theoretical $1,200 deduction intended to offset the cost of the insurance premiums. However, if Kevin had opted out of the insurance, he would face the divorce surcharge, a theoretical penalty of 2.5% of his gross household income, paid directly to the National Marital Stability Fund to pre-fund the potential social cost of his household's dissolution. Step by step, the math of the divorce surcharge is designed to be a nudge. The government isn't telling Kevin he can't get divorced. They are simply making it more expensive to be uninsured. This is based on the economic theory of externalities. In the same way that a carbon tax makes polluters pay for the environmental damage they cause, the divorce surcharge makes uninsured couples pay for the potential social damage of their financial instability. The theoretical goal is to create a self-funding system where the private insurance payouts handle the first 12 months of a household split, covering rent, legal mediation, and childcare, thereby preventing the poverty spiral that typically lands newly divorced individuals on the public ledger. But the federal intervention goes deeper than just tax credits. We must examine the potential outcomes of the federal reinsurance program. In this 2026 model, the government acts as a backstop for private insurance companies. If a catastrophic economic event, like a localized recession in the manufacturing sector, causes a sudden, massive spike in divorce rates that threatens to bankrupt private insurers, the National Marital Stability Fund steps in to cover the claims. This is identical to how the government backstops flood insurance or terrorism insurance. It stabilizes the market and ensures that even in times of national stress, the divorce safety net remains solvent. Furthermore, let's explore the step-by-step integration of these policies with the U.S. Census Bureau and the Social Security Administration. In 2026, the government would likely use predictive modeling to identify at-risk jurisdictions. Historical trends show that certain geographic areas in the U.S. have significantly higher divorce rates due to economic volatility or cultural factors. Under a theoretical federal model, the government could provide additional grants to community organizations in these high-risk areas that offer the mitigation services required by insurance policies, such as subsidized financial counseling or conflict resolution workshops. This turns the insurance market into a proactive tool for social engineering, where the state uses financial incentives to strengthen the underlying stability of the American family. However, this level of state involvement triggers a massive debate over the registry of resilience. To set federal backstop rates, the government would need to maintain a database of marital duration, stability, and even near-miss events where couples almost divorced but utilized insurance-funded counseling instead. For many Americans in 2026, this feels like an unprecedented invasion of privacy. Imagine if your eligibility for a small business loan or a federal mortgage was influenced by your marital resilience score on a federal database. The theoretical review of this market reveals a tension between the efficiency of the state and the autonomy of the individual. To add more depth to this masterclass, let's look at how this federal model would interact with the existing 2026 welfare system. If a mother in 2026 applies for temporary assistance for needy families, TNF, following a split, the state would first check if there is an active divorce insurance policy. If a payout is available, the insurance company, not the state, becomes the primary payer for the first 6 months. This is a payer of last resort model. It shifts the burden of social support from the taxpayer to the private insurance pool, which is funded by the premiums of the married population. Critics argue this is essentially a marriage tax, while proponents see it as a necessary evolution of the social contract in an era of high marital volatility. Consider the imagine-if scenario where a state like Utah or Oklahoma, which have historically experimented with healthy marriage initiatives, decides to opt out of the federal plan to create their own state-level marital equity funds. We would see a fragmented market where the cost of being married varies wildly depending on which side of a state line you live on. This creates risk migration, where high-risk couples move to states with better subsidies, eventually collapsing the state-level pools. This is why most 2026 theoretical models insist on a federal-level framework to ensure the risk is spread across the largest possible population. As we conclude this part of the deep dive, the role of the government as the invisible underwriter is clear. They are the ones setting the rules of the game, defining what counts as a loss, and deciding who gets a tax break and who gets a penalty. But while the government is looking at the macro-level statistics, there is another player entering the market with a very different set of incentives. In 2026, your employer is no longer just providing health insurance and a 401k. They are looking at your marriage as a key factor in your corporate performance. In the next part, we are going to expose the corporate custody model. What happens when your boss is the one who owns your divorce insurance policy? We will explore the rise of retention-based marital benefits and how companies are using your relationship status as a leverage tool for long-term employment. Imagine a 2026 where your HR department has a marital support officer who knows more about your home life than your therapist. We are moving from the tax office to the corner office, and the new rules of employee stability are about to change the way you look at your paycheck. The workplace is about to get a lot more personal. Keep watching because your career and your marriage are about to become officially inseparable. In the corporate landscape of 2026, the traditional boundaries between a person's professional output and their private life have effectively evaporated. For the modern U.S. employer, the financial stability of their workforce is no longer a secondary concern. It is a critical operational variable. This has birthed the corporate divorce insurance model, a theoretical framework where companies provide marital risk protection as a core component of a high-tier compensation package. To understand why this shift is happening, we have to look at the historical trends of productivity loss. Data indicates that an employee undergoing a contested divorce in the United States experiences a drop in billable efficiency of approximately 40% for the first year of the proceedings. When you factor in the cost of turnover, which for a specialized executive can be up to 200% of their annual salary, the business case for ensuring an employee's marriage becomes a simple matter of protecting the bottom line. Imagine a 2026 case study involving a character named Marcus, a lead systems architect for a high-frequency trading firm in Austin, Texas. Marcus is responsible for maintaining the infrastructure that processes millions of trades per second. His role is high stress, high stakes, and requires absolute mental clarity. When Marcus enters a period of significant marital strain, his employer, Ether Dynamics, is immediately alerted through a predictive performance algorithm that tracks his response times and error rates. In a pre-2026 world, Marcus might have been placed on a performance improvement plan or even terminated. However, under the corporate custody model, Ether Dynamics triggers the marital support benefit. The process is managed by an internal marital support officer, or MSO. This is a specialized HR role that acts as a liaison between the employee, the insurance carrier, and external legal and psychological resources. The step-by-step implementation of this benefit for Marcus is precise. First, the MSO facilitates a 72-hour cooling-off period, where Marcus is granted a paid sabbatical to deal with the immediate domestic crisis. During this time, the corporate insurance policy covers the cost of an elite mediation team. The goal here is not necessarily to save the marriage, but to ensure that the dissolution, if it happens, is handled with the surgical efficiency of a corporate merger rather than the chaos of a street fight. By removing the financial anxiety of legal fees and asset division from Marcus's mind, the company ensures that when he returns to his desk, his focus is back on the trading algorithms. From an actuarial perspective, the potential outcomes for Ether Dynamics are significantly more favorable than the alternative. If they didn't provide this insurance, they would face the cost of hiring and training a replacement for Marcus, a process that could take 18 months and cost the firm hundreds of thousands of dollars in lost opportunity. By paying a monthly premium for Marcus's divorce insurance, they are essentially hedging against his future distraction. This is the financialization of human capital in its most literal form. We are seeing a historical trend where large U.S. corporations are becoming the primary underwriters of their employees' personal lives, effectively acting as a private welfare state for their most valuable assets. However, this model creates a profound ethical and legal conflict regarding the ownership of data. In the theoretical 2026 market, if the company is paying the premium, do they own the data generated during the claim process? If Marcus uses the corporate insurance to fund his divorce, the insurance company and the HR department may have access to sensitive financial disclosures and even transcripts from mediation sessions. This leads to a scenario where a person's career trajectory could be subtly influenced by their marital stability rating, held by the company. Imagine if Marcus is passed over for a promotion because the MSO's report suggests that his home life is too volatile for a high leadership role. The insurance that was meant to protect his assets becomes a ceiling for his career. Furthermore, we must explore the clawback clause, a standard feature in 2026 corporate policies. If Marcus receives a $150,000 payout from the corporate divorce insurance to settle his marital affairs, but then decides to leave Ether Dynamics for a competitor 6 months later, he may be legally required to repay the insurance benefit in full. This creates what sociologists call the golden handcuffs of stability. Marcus is no longer just tied to his job by his salary or his stock options. He is tied by the debt of his domestic peace. The insurance payout functions as a high-interest loan that is only forgiven if he remains a productive, loyal employee for a specified vesting period. To add more depth to this review, let's look at the impact on the broader U.S. labor market. If only elite firms like Ether Dynamics offer this level of protection, we see the emergence of a marital class divide. Top-tier talent is shielded from the economic wreckage of divorce, while the average American worker remains one legal filing away from bankruptcy. This creates a feedback loop where the most productive members of society become even more stable, while the middle and lower classes face increasing volatility. Historical trends in U.S. healthcare show a similar trajectory, where the quality of your safety net is entirely dependent on the quality of your employer. Step by step, a corporate divorce insurance claim in 2026 also involves a liquidity bridge. In many cases, the most painful part of a divorce is the sudden lack of cash to secure a new residence or pay for separate household expenses. The corporate policy often includes a zero-interest bridge loan that is automatically deducted from the employee's future bonuses. For Marcus, this means he doesn't have to raid his 401k or take a predatory loan to move into a new apartment. The company provides the liquidity, and in exchange, they gain further control over his future earnings. The educational review of this system shows that it is a masterful tool for risk management, but a terrifying tool for personal autonomy. We must also consider the role of the forensic actuary in these corporate settings. These are professionals who work for the insurance companies to ensure that employees aren't colluding with their spouses to trigger payouts. In 2026, the investigation into a corporate claim is rigorous. They will look at the timing of the divorce filing in relation to the company's fiscal year and the employee's bonus cycle. If they find evidence of strategic separation, the claim is denied, and the employee could face internal disciplinary action for attempting to defraud the company's benefit system. Your divorce isn't just a legal matter, it is a compliance matter. As we look at Marcus sitting at his desk, his algorithms running perfectly while his personal life is being professionally managed by a suite of corporate tools, we have to ask what this means for the future of the American dream. We are trading the messiness of freedom for the sterile safety of corporate oversight. But there is an even more advanced version of this risk management strategy emerging in 2026. It moves beyond the corporation and into the realm of the individual's digital identity. In the next part, we are going to look at the individual risk mitigation strategies that are being used outside of the workplace. We will explore the self-insured single and the rise of the marital escrow account. What happens when you decide to be your own insurance company? We will break down the 2026 strategies for hardening your assets against a future split before you even meet a partner. We are moving from corporate control to radical individual insulation. You will see the specific financial vehicles that are being designed to make a person divorce-proof from day one. This is the ultimate guide to financial fortification in an age of uncertainty. The rules of engagement are changing, and you need to know how to shield yourself. Keep watching because we are about to enter the vault. Entering the vault of individual risk mitigation in 2026 requires a fundamental shift in how we perceive the financial boundaries of a relationship. For the self-insured individual, the strategy is no longer about a defensive document signed in a lawyer's office. It is about the active hardening of assets through a methodology known as the anti-commingling protocol. In the United States, historical trends in family law have consistently shown that the greatest vulnerability for a spouse is not the divorce itself, but the accidental commingling of separate property with marital assets. In 2026, the theoretical market has responded with a suite of tools designed to automate the segregation of wealth, effectively creating a financial firewall that exists independently of a traditional insurance carrier. Imagine a case study involving Ethan, a 32-year-old biomedical researcher in Seattle. Ethan has spent the last decade accumulating a significant portfolio of intellectual property and high-growth equities. As he prepares for marriage in 2026, he does not look for a traditional insurance policy. Instead, he implements a personal asset fortification plan. This begins with the deployment of a digital tracing ledger. In the U.S. legal system, the burden of proof often falls on the person claiming an asset is separate. If Ethan cannot prove with 100% certainty that the money used to buy a specific stock came from his premarital savings rather than his marital salary, a 2026 judge may rule that the asset has been transmuted into marital property. Step by step, Ethan's ledger operates as a continuous forensic audit. Every dividend, every capital gain, and every interest payment is automatically tagged and routed into a series of isolated subaccounts. This is the logic of the self-insured single. They are essentially running their own private insurance pool by ensuring their downside is capped through extreme organization. The potential outcomes of this strategy are significant. In a theoretical 2026 divorce scenario, Ethan's legal team would not need months of discovery to identify separate property. They would simply export a cryptographically verified report of the last 5 years of transactions, making the division of assets a mechanical process rather than a litigious one. However, the protocol goes deeper than just software. We must examine the rise of the Domestic Asset Protection Trust, or DAPT, as the ultimate 2026 insurance alternative. Historically, these trusts were reserved for the ultra-wealthy, but in the theoretical market of 2026, specialized boutique firms have democratized access for the upper middle class. ADAPT is a self-settled spendthrift trust allowed in specific U.S. states like Nevada, South Dakota, and Delaware. By placing his premarital assets into a DAPT, Ethan effectively moves them into a separate legal entity. In the eyes of the law, the trust owns the assets, not Ethan. The mechanics of this fortification are fascinating. Even if Ethan is the beneficiary and can receive distributions, the assets within the trust are shielded from most creditors, and in some jurisdictions, from marital claims during a divorce. This is the vault. It functions as a form of self-insurance because Ethan is paying the administrative costs of the trust in lieu of an insurance premium. If a divorce occurs, the trust provides a pre-funded pool of capital that remains untouched by the courtroom proceedings. But there is a catch that we must review: the 2026 judicial pushback. U.S. family court judges are increasingly viewing these aggressive trust structures as a violation of the principle of equitable distribution. We are seeing a historical trend where courts in states like California or New York are attempting to pierce the corporate veil of these trusts if they believe they were established with the intent to defraud a future spouse. This is why the timing of the fortification is critical. In the 2026 theoretical market, the most effective self-insurance is that which is established years before a marriage even begins. This is the era of the long-term hedge, where young professionals are hardening their financial lives in their early 20s as a standard part of their adulting checklist. Now let's look at another scenario involving a character named Ava, an entrepreneur in the 2026 creator economy. Ava doesn't just use trusts. She utilizes a hybrid escrow model. This is a theoretical financial vehicle where she and her partner agree to a marital escrow account as a condition of their lifestyle. Unlike a joint checking account, the MEA is a smart contract-governed fund where both parties contribute a percentage of their income, but the funds are only accessible for mutually agreed-upon marital milestones, such as a home purchase or a child's education. If the marriage dissolves, the MEA has a pre-programmed liquidate and exit function. Step by step, the contract calculates the contributions of each party, adjusts for inflation, and returns the principal to each individual while splitting the interest. This is the 2026 version of a no-fault refund. By using this model, Ava ensures that the most volatile portion of their shared wealth, their liquid cash, is never subject to a judge's discretion. It is a form of private, code-based insurance against the friction of a legal split. Furthermore, we have to consider the role of the synthetic prenup. In 2026, many individuals are bypassing the emotional difficulty of asking for a prenup by instead utilizing a series of overlapping LLCs and holding companies. Ava might hold her primary business interest in a Wyoming LLC, which is then owned by a family trust, which is then managed by a professional fiduciary. This layering creates a level of complexity that makes the cost of attack for a divorce attorney higher than the potential payout. This is the defense by exhaustion strategy. It is not an insurance policy that pays you. It is a structural defense that makes you too expensive to sue. To add more depth to this masterclass, we must look at the 2026 legal defense rider. While we have focused on asset protection, the most immediate cost of a U.S. divorce is the litigation. Some forward-thinking casualty insurers have begun offering riders on standard homeowners or umbrella policies that provide for family law mediation coverage. This isn't divorce insurance in the sense of a payout, but rather a prepaid legal plan. If Ava's marriage enters a period of distress, her umbrella policy triggers a $25,000 credit for a pre-vetted mediation firm. This is an educational example of how the traditional insurance market is slowly evolving to meet the needs of the modern U.S. household by focusing on the process risk rather than the asset risk. But there is a fundamental question that all these individual strategies must eventually face. If everyone in 2026 is fortifying their own vault, what happens to the concept of the shared life? We are seeing the emergence of a transactional marriage culture, where the financial safety of the individual is prioritized over the collective stability of the union. This creates a psychological feedback loop that can, ironically, increase the very risk the individual is trying to mitigate. As we wrap up this exploration of individual fortification, we have covered the tech, the trusts, and the smart contracts. We have seen how Ethan and Ava are using 2026 tools to build their own financial fortresses. But we haven't reached the end of the story. The theoretical U.S. divorce insurance market is at a crossroads. The clash between private innovation, corporate control, and government intervention is reaching a breaking point. In the final part of this masterclass, we are going to look at the global forecast. We will synthesize everything we have learned, from the actuarial math of Part 2 to the blockchain logic of Part 6, to predict the ultimate fate of this market. Is divorce insurance the future of American social stability? Or is it a failed experiment in the commodification of the heart? We will reveal the black swan event that could force the entire U.S. insurance industry to adopt these models overnight. You need to see the final verdict on the divorce-proof society. This is the conclusion you've been waiting for. The future of your family's legacy depends on what happens next. Keep watching. The realization that the U.S. legal system may no longer be equipped to handle the financial complexities of the modern household has led us to the ultimate question. What is the final verdict on the theoretical divorce insurance market of 2026? To find that answer, we must examine a potential outcome that experts call the great marital decoupling. This is a scenario where the state fundamentally yields its role as the arbiter of marital property to the private insurance sector. In this 2026 landscape, we are looking at the possibility of the Federal Family Solvency Act. This theoretical legislation would effectively turn the U.S. divorce system into a no-fault, administrative process where the primary goal is not justice, but the rapid restoration of individual liquidity. In this final part of our masterclass, we will break down the three pillars of the divorce-proof society: the mandate, the algorithm, and the legacy. The first pillar is the legislative black swan. Historical trends in the U.S. insurance industry show that major shifts usually follow a systemic failure. Just as the 2008 financial crisis led to the Dodd-Frank Act, a theoretical 2026 insolvency crisis, where the national alimony default rate exceeds 40% due to economic volatility, would likely trigger federal intervention. Step by step, the implementation of a national marital bond would begin at the county level. When a couple in 2026 applies for a marriage license in a city like Chicago or Dallas, the clerk would not just ask for an ID and a fee. They would require proof of a stability bond. This bond is essentially a performance insurance policy for the marriage. If the marriage fails within the first 5 years, the bond pays out a baseline subsistence benefit to any children involved, bypassing the court system entirely. This turns the social contract into a bonded contract, ensuring that the taxpayer is never the first line of defense for a broken home. Imagine the case study of a 2026 character named Samantha. Samantha is a high-earning marketing executive who is about to marry for the second time. Because she lives in a state that has adopted the theoretical Family Solvency Act, her marriage license is contingent on her securing a Tier 1 stability bond. The premium is based on her previous divorce history and her current debt-to-income ratio. For Samantha, this insurance is not an optional luxury. It is a prerequisite for legal recognition of her union. This is the birth of the divorce-proof society, where the financial risk of a split is pre-funded at the moment of inception. The potential outcome is a massive reduction in the U.S. court backlog, but at the cost of the traditional idea of marriage as a purely private, non-commercial covenant. The second pillar is the rise of the algorithmic mediator. By late 2026, the theoretical market has moved beyond simple payouts and into active risk management. We are seeing the development of the perpetual underwriting model. In this scenario, the insurance company does not just sign a policy and wait for a claim. They use real-time sentiment analysis to prevent the claim from ever happening. Step by step, the insurer's AI monitors the digital health of the marriage. If the frequency of joint financial transactions drops, or if the couple's shared location data suggests they are spending more nights apart, the algorithm triggers a proactive intervention. This might include a mandatory, insurance-funded retreat or a meeting with a financial therapist. This is the ultimate expression of the moral hazard mitigation we discussed in Part 2. The insurance company becomes the silent, data-driven guardian of the marital bond, because their profit depends on the couple staying together. Consider the data from a 2026 pilot program in a tech-centric jurisdiction like Seattle. Historical trends from this theoretical project show that couples who opted into the algorithmic monitoring had a 15% lower divorce rate than those who relied on traditional counseling. Why? Because the AI identified the points of friction months before the couple was even consciously aware of them. However, we must review the step-by-step privacy cost of this system. To save their marriage, Samantha and her partner must surrender their digital autonomy. Every text, every purchase, and every search query becomes a data point in a marital resilience score. In the quest to be divorce-proof, they have become digitally transparent. This is the paradox of the 2026 market. To protect your future, you must sacrifice your privacy. The third pillar is the legacy shield. This is where we look at the global forecast and the competitive landscape of 2026. While the US is leading the way in the commodification of marital risk, other nations are watching closely. In a globalized economy, the stability of a nation's families is a key indicator of its long-term sovereign credit rating. If the US can successfully implement a divorce insurance market that stabilizes the middle class, it becomes a model for the rest of the world. But if the market fails, it leads to what economists call the domestic brain drain, where high-net-worth individuals move to jurisdictions with more predictable family laws. The final verdict on the divorce-proof society is that it is a necessary, albeit cold, evolution of the American dream. We have realized that love is a sentiment, but marriage is a multi-trillion-dollar industry, and in 2026, the industry requires an insurance policy. Step by step, the 2027 to 2030 projections for this market suggest that divorce insurance will eventually be bundled with other major life products. You will not buy a home without homeowner's insurance, and you will not buy a home with a spouse without marital stability insurance. The two will be linked by the bank as a way to protect the mortgage. This is the total integration of the family into the financial grid. We are moving toward a future where a divorce is no more legally or financially traumatic than a minor car accident. You file the claim, the mediator arrives, the assets are redistributed according to the smart contract, and the parties move on. The emotional trauma remains, but the financial ruin is engineered out of existence. But even as we reach this state of total risk management, one variable remains that no algorithm in 2026 can fully account for: the black swan of the human heart. We have built vaults, we have written code, and we have mandated bonds, but the theoretical market still struggles to price the unpredictable nature of human growth and change. As we conclude this deep dive masterclass, we see a world that has mastered the math of heartbreak, but is still searching for the meaning of commitment. The theoretical US divorce insurance market has provided the tools for survival, but the definition of a successful marriage remains outside the actuarial tables. As we look toward the next decade, the conversation is already shifting. If we have insured the marriage, what is next on the list of uninsurable risks? We are seeing the first whispers of a new theoretical market that makes divorce insurance look simple. It involves the insurance of your professional reputation and the protection of your digital legacy against the rising tide of AI-driven deepfakes and social cancellation. We have figured out how to protect the house and the 401k, but can we insure the very essence of who we are? In our upcoming series, we are going to dive into the high-stakes world of the reputation market and the rise of the social equity policy. You have seen how we protected the marriage, now you need to see how we protect the name. The next level of the 2026 economy is about to be revealed, and the price of entry is higher than you think. Keep watching for the launch of the Reputation Protocol.